All right. Hello, everyone, and thank you all for joining us during the Lytham Partners Winter 2021 Investor Conference and what we're aptly calling our 2022 Vision Event. My name is Robert Bloom, Managing Partner of Lytham Partners. During this fireside chat, we welcome Vox Royalty, ticker symbol of VOX on the TSX Venture and VOXCF on the OTCQX, and their CEO, Kyle Floyd. Before we begin, for those not familiar, Lytham Partners is one of the country's leading investor relations firm with more than 2 decades of corporate access experience. We've built one of the industry's most diverse and effective platforms for connecting small companies with high quality and focused institutional investors, while at the same time creating a framework of best practices in all aspects of investor relation. Today's fireside chat is hopefully another example where we can bring value to multiple constituents here. We'll dive into questions in just a moment, Kyle, but one final item. I want to remind everyone that Kyle will be available for one-on-one meetings later this week. If you've not already signed up, you can send me an email. Again, that's Bloom, B-L-U-M, @lythampartners.com, or go to the website, lythampartners.com/virtual. You can click on the one-on-one meeting request button and we'll get you taken care of. So with that, let's begin. Kyle, maybe just a little bit of background on yourself before we get started here.
Sure, Robert, and thanks for having me on the program. It's a really exciting time for Vox Royalty Corp. I founded this company back in 2014 after running the mining investment banking division for a firm called Roth Capital, and went about building a company in the mining sector, more generally in the commodity sector, really for the generalist investor to get the right kind of exposure to commodities long before inflation was ever top of mind as it is now. And really, we went about building a company that focused on generating the best risk-adjusted returns you could find in the commodity sector, and that's with a royalty company. And so when really utilizing all the experience that I had and combining that with the technical expertise of the team that we have now, we've generated some of the highest returns on invested capital in the entire industry. We've led the industry in growth, but it's really been at the focus of our business has always been the investor, and how do we deliver the best risk-adjusted returns in the industry. For most generalist investors, it's very hard to understand mining companies at a detailed level. It's very esoteric forms of risk and opportunity. And so we've built what we believe is one of the best engines for growth that's going to be really the most fruitful for investors and the easiest to understand as well.
So to your point, I think this is probably new for many or investors. So let's sort of take a step back. Let's begin with background on the industry, I guess, first off. So, talk about mining royalties, why you believe it's an attractive investment beyond some of the things that you just mentioned there.
Yeah, and so what a royalty company does, Robert, is we buy a top line percentage of revenue. And so we're not the operators, we're not the team that's running a mine. And so a lot of the risks and a lot of the challenges that come with those operations, we don't experience as the royalty company. We just take a percentage of the revenue or the future revenue that mining asset's going to generate. And so what we specialize in is buying what's called third-party royalties, these revenue interests that are held by what would have been the prospector or maybe the junior mining company or the family that had ranching land or, you name it, different land and opportunities where a geological anomaly was discovered. And they essentially vended that land out in return for usually cash and a royalty. We go find those royalties that are held by all these eclectic groups all over the world, and that's what we buy. And that allows us to not be constrained by mining companies looking for capital. We don't originate the purchase of royalties and streams. We go into this, essentially this secondary market looking for these third-party royalties, and we're buying revenue interests in these potential mines. Some are already in production, some we expect to be in production, and that means we're not exposed to any of the challenges that these mines face in terms of raising capital, in terms of the cost overruns that can happen. We're not exposed to the cost structure because, again, we're at the top line revenue. We're not exposed to their variable costs or fixed cost structure. So it's a really enviable position that we accumulate for our investors, in that we strip away a lot of the risk, but retain really an undiluted, and in most cases, an uncapped upside in these mining projects.
So let's talk a little bit about the history of mining royalties. What how did this evolve, and what's been taking place in it recently in the industry?
So mining royalty companies have outperformed really every major commodity-based benchmark that you can compare these companies to. And so when we talked about why the company got started and why we created it, it was because when you look at the commodity sector overall holistically, there are a few very bright shining stars and a lot of asset classes that frankly don't return well on a risk-adjusted basis. Royalty companies are an anomaly in the commodity sector in that they've outperformed the S&P 500 over the last 15 years. They've outperformed the ETFs. They've outperformed the physical. They've outperformed the miners. It's been a very, very fruitful place to park capital. And so when we looked at what was really successful in the royalty sector and we distilled what the large companies that have been very successful for a long period of time, how did they build those companies? What did they do that ultimately created that alpha in the commodity sector? It was buying third-party royalties. And so you look at the history of the industry, really Franco-Nevada, Wheaton Precious Metals, Royal Gold, really the three kind of pillars in the industry. They're all multi-billion-dollar companies. And what they did is they initially, Royal and Franco, started buying what's called the third-party royalties that we buy. They started doing that in Nevada in the late 80s and early 90s. And the success of that business model and the success of those acquisitions really has propelled them to generate the types of returns that they have, which is more than 1,000% on average over that time period. And so we took that business model, we took what it did really, really well, how it generated the best returns for their shareholders, and we've applied that. And we've applied that in areas where we have competitive advantages. One of those is we have a database of over 8,500 now proprietary royalties all around the world that gives us an edge in sourcing opportunities. And we also looked at where can we find an edge in terms of finding royalties. Nevada has been historically a great mining jurisdiction, but frankly, it's a little picked over. Where can we find a jurisdiction that's just as good as Nevada, where there's still a lot of opportunities and uncompetitive waters? And we found that in Western Australia, which is, in my opinion, the best mining jurisdiction on the planet. And so we've actually become the second largest holder of hard rock mining royalties in all of Australia after Franco-Nevada. So we've looked at where we can find competitive advantages. We've distilled the royalty model to the core characteristics that really created shareholder value, and we've delivered that in spades for our shareholders as we've continued to grow the business.
Well, maybe you just touched on it there, but what do you see as that key differentiator between yourself and maybe a couple of other royalty companies that are out there?
Well, the royalty companies that I just mentioned are very large, very big businesses. Franco's a $30 billion plus company. And so some of the core or key differences between us and those companies is we're able to find royalties that are really below their radar and are not known by most of our comps or peers in the marketplace. And so we've completed 24 royalty acquisitions over the last 3 years, leading the industry in growth. And to the best of our knowledge, none of those have been shopped. So we've been able to find royalties where we can negotiate at arm's length with third parties, not in processes. And the key differentiator is these deals are really, really valuable. We've gotten them at really good pricing for our shareholders, and they move the needle. So these deals that we're finding don't necessarily move the needle as much for a $30 billion company, but for a $110 million market cap company like Vox, they really create a lot of value for our shareholders. So we've been able to find essentially better value at the end of the day with what I also believe is better upside. And I think that's a unique position to be in, to be generating for shareholders in this industry.
So you mentioned some of these below the radar type opportunities. When you're looking at a royalty investment, what are the couple of top key themes that you're looking for?
So first thing that we're looking at is and when we built this company, one of the things that, again, top of mind for us and the problem that we were solving is the mining industry is a very esoteric industry. Not many folks are either a mining engineer or a geologist or have 30 years of experience investing in the space, which is really what you need to have to ultimately generate, to use a portfolio management term, alpha in this sector. Otherwise, generally speaking, the metal spaces have been really poor performers for a very long time. There's a lot of people shouting from the mountaintop that gold's going to go to 10,000 and metal prices are going up. Look, that might happen, but we built a business around using fundamentals, and if metal prices go up, which personally I expect they will, but that's not how we run the business. We're using our technical team to understand the risks and understand the opportunities far better than our peers, and in a way that really a generalist can appreciate. It's our mining engineers and our geologists doing the technical work so they don't have to, because you really should be doing that when you're making mining investments. And so we've been able to use this technical team to find really good projects. So what we're looking for is usually projects that are anywhere from, call it 2 to 4 years out, maybe 2 to 5 years out from production, where our mining engineers and our geologists are looking at these projects saying they're going to perform probably better than expectations and better than the price at which we would buy the royalty. So we're finding value, but we're finding value understanding the quality of the asset first. Quality of the asset also depends on the jurisdiction. So Western Australia being the best mining jurisdiction on the planet, that's been a focus for us. Jurisdiction weighs into it. 80% of our assets are either in Australia, Canada, or the US. And so I think stability of rule of law as it pertains to mining projects and royalties is a big thing. And then upside. If we protected our risk appropriately, then what's the upside opportunity for us? And so those are kind of the 3 key pillars that we're looking for. Generally, great jurisdictions, very, very good projects that present really good risk-adjusted upside for our shareholders.
So maybe expand upon what does that team look like? That technical team that's out there that's evaluating these investments. Talk through what the team looks like a little bit more.
Absolutely. So we have 4 key individuals on our business development team, including myself. Outside of me, everyone is very, very technical. So Spencer Cole, our chief investment officer, mining engineer, deep finance background as well, worked at some of the world's largest mining companies, in fact, BHP and then South 32. Simon Cooper is both a mining engineer and a geologist. He's our EVP of corporate development and has worked at some of those interesting projects all around the world. And then Rhiannon Easter, is really a renowned geologist. He's led the greenfields exploration campaigns for really the who's who of major mining companies. And so we have this technical team that's really capable and devoted to doing the right kind of work to make sure that we're buying the right kind of assets. And you see that continually in our portfolio as what we call our organic growth. So what we've already purchased, what that's producing in the portfolio continues to compound on itself and create value for our shareholders without us putting another dollar into those mining operations. And so it's that technical team at the front lines of our business. It's a key differentiator, but it's there for a purpose. It's there for a generalist investor that doesn't know, the details of mining engineering and geology or metallurgy, and want someone to be doing that work in the best format for investing, which is, in our opinion, and I think the data backs us up, buying third-party royalties.
All right, let's transition here a little bit. Inflation's obviously been a topic, almost every industry. How do royalty companies typically perform in potentially high inflationary type environments?
Well, royalty companies are a really unique opportunity for investors in that, one, we have great diversification. So we have 50 plus royalties and streams. And so we don't really have the single asset risk that a lot of mining companies do. How is that important in an inflationary time? In inflation, there's a lot of costs and changes that surprise mining companies that they really can't plan for. And so those can have deleterious impacts on those operations. We're already seeing that to a large extent in what people announce in terms of or companies announce in their third quarter earnings, is that inflation's having I think unforeseen consequences. So that diversification is huge. The other, and what I would say is probably the key thing to be thinking about as an investor is, say gold goes up. Again, we don't build our business model around gold and metal prices going up. We actually build it around consensus forecasting and backwardation, which has metal prices going down. So we are endeavoring and doing a good job at making you money, even if metal prices contract from here. And that's what I believe investors should be looking for when they're making investments in this space. But if gold goes up, inflation goes up, what happens? Well, the cost inflation that miners are experiencing is very significant. Remember, our interest is on the top line revenue of most of these operations, which means their variable costs going up or their fixed costs going up, which they are significantly for fuel, infrastructure, people, consumables, you name it. Those costs are going up significantly. So they're eating the margins of the mining company if metal prices aren't keeping up with that, which they haven't been over the last quarter. So the reality is our top line interest is really protected against that inflation risk. And eventually, obviously, if inflation persists I personally believe that it will. It historically has. And if it does, you would expect that the underlying commodity prices increase. Well, in that environment, you continue to have this shortage of labor. There's not enough people to mine the amount of projects that are going to need to come online to support the industry. So the people cost, the rising cost pressures in the industry are going to persist. Ultimately, again, supply isn't going to increase as much as people would expect, driving prices higher and compounding. But costs of mining companies are going to continue to go up because of these inflationary pressures. A royalty company is not exposed to most of those cost pressures. And so you get the benefit of inflation protection and the upside in commodity prices without the risk that those cost inputs end up taking away or eating away your margins.
Very interesting. Let's go back to some of your projects. You're looking under a lot of rocks for opportunities out there, right? Turning stones over. What are some of the most unique or strange locations that you found for some of your investments?
So it's interesting. We get this question quite a bit, and we've been the fastest growing company in the industry. It's not what we talk about that much, to be honest, because we're more focused on finding really good value on a risk-adjusted basis with great upside. But we have led the industry in growth. We've completed over 24 acquisitions, bringing in more than 40 royalties over the last 3 years. We have looked at probably more than 1,000 projects to get to those 24. So it's been 1,000 projects that we've looked at to get to probably about 100 LOIs, and we've executed on 24 of those. And we've looked at royalties and transacted on royalties in some of those unique hands and eclectic hands all over the world. So these third parties that we bought their royalties have been telecommunications companies, hearing aid technology businesses, automotive parts companies, families that own land in South America, families that own a ranch in Nevada, doctors in West Africa. So you name it, we've transacted on more eclectic royalties than anybody else in the industry. And that's the hunt that we're on. We're looking for value wherever it can be found all over the world. And we've created a pretty dominant position in doing so.
In terms of the sourcing of some of these, how are you looking to source these potential investments?
So a lot of it is we have built this company over the better part of the last decade. Our team has over 40 years of experience in specifically in this royalty industry, which is a unique space to say the least, and over $1.5 billion of royalty transactional experience. And so we've been building this capability to transact at a systematic, repeatable level with competitive advantages that I'll tell you, no one else in the space has built quite like us. So part of those competitive advantages, we have a royalty database that we both built and acquired. We paid $2.1 million for this back in 2019. That gives us a proprietary advantage over 8,500 royalties that are held by third parties in that database. The other thing that we've done is we've built a global sourcing network. So we can get face-to-face in pretty much any major mining market with a royalty holder. Even if our team, which is a full-time team of 6, doesn't happen to be in that local market, we can get someone that works as an extension of Vox to be in person and help us make what is a very complicated process of buying a royalty, a personal process that's allowed us to be successful. And then again, the technical team at the front lines of our business allows us to very quickly analyze opportunities, understand what the value is, and be able to transact with efficiency systematically.
All right. Most understood or undervalued aspect from your perspective of Vox is what?
I think the undervalued aspect to this is that our interest is undiluted. So it's top line revenue interest that's undiluted. And when things are going well for these mining companies, they have plenty of capital. Well, again, they're raising a lot of capital, but we're not diluted by that. And what happens is you get this multiplier effect. So across our 50 plus royalties and streams, what's happening right now is these mining companies are incentivized to increase the resources, increase the reserves, increase production on the back of that. Then they're incentivized, if metal prices are higher, to continue doing that, where it becomes this multiplier effect where we're not contributing capital for that growth and we're not diluted. So you end up getting this compounding interest in your favor. And when you run the math out, versus an equity position in a mining company versus owning these royalties, you end up with usually a 5 to 10x type of return profile with a lot less risk. And that's what's generally misunderstood or not well known about royalty companies. And a company like Vox that has 30 assets that we believe have potential to be in production in this cycle is huge. And that's going to continue to provide growth that we're not paying for and not diluted by for our shareholders.
Let's look at the milestones over the next, we're kind of calling this our 2022 vision event. Over the next 12 months or so, what are the key milestones investors should be looking at? And if we were to sit down again 12 months from now, what are the biggest risks to achieving some of those goals?
Look, I think the big thing for investors, ultimately, what we're specializing in is buying royalties right before production. So, usually say a quarter to 3 to 4 years out from production. And that's allowed us to buy what is probably the best valued portfolio in terms of dollars in and expected dollars out in the industry. And so what you see with our portfolio and what investors can expect is we went public in just May of last year with 1 producing asset. We now have royalties over 5 producing assets. We're expecting that number to go to 10 by the end of 2023. And so that continued growth of producing assets over that period of time obviously has a pretty profound impact on our EBITDA and our bottom line. But also, so those are kind of the big catalysts to be watching out for. But then we have 5 projects that we have royalties over that are going to be announcing feasibility studies over the next year. So those are huge de-risking milestones. They're increasing the probability that they come into production in the near term, and they're giving us a better idea of what those economics are going to look like. So that's what's happening in our portfolio. And then you complement that with, again, our ability to find deep value in the acquisitions that we're purchasing. The market will see that we continue to be able to execute at a very high level in terms of finding value for our shareholders.
All right. We're almost at the end of the time. Anything else that you want to sort of share or you think investors should take away from the discussion here?
Look, it's a really exciting time to be a Vox shareholder. There's a lot of uncertainty in the market right now. I think one of the only certain things is probably volatility, inflation, and so where do you invest in call it a small cap type of landscape? And I think Vox presents a really unique opportunity. We're really well positioned. The fundamentals of the business continue to build. We continue to find value, and we're positioned to win in the metals, even if metal prices don't go up. But that ability for us to deliver and what happens for our shareholders in a rising metal price environment. Again, inflation is not a risk for us. It's a risk for mining companies. And so you get the benefits of what inflation can do in terms of bringing metal prices higher without the challenges that it presents from a cost perspective. And so I think we present a really unique opportunity for the generalist investor right now that's looking to get exposure to this sector and looking for the best way to do so. We've built a business purpose-built to accomplish that for investors, and we continue to deliver on that mission.
Fantastic. Kyle, well, that was great. Thank you so much for your time today. Greatly appreciate it. Once again, anyone out there that is not already signed up for a one-on-one meeting, send me an email, Bloom, BLUM at lythampartners.com. Or once again, you can go to the website, lythampartners.com/virtual. Click on the one-on-one meeting request button. We'll get you taken care of. We hope you all enjoy the conference. Kyle, thank you again very much.
Thanks, Robert. It's been a pleasure.